Trading stock. Trading stock is defined in Section 1, and remember that it would include shares of a share dealer. You need to know how to calculate and take into consideration opening stock, closing stock, and the cost of trading stock. Also consider if there is a change of intention from revenue in nature, selling it as trading stock, to capital in nature, so maybe taking the trading stock and using it within the business. The general rule is that we recoup at market value, and there are 3 exceptions, which we'll have a look at later. Closing stock should be included at cost or an amount approved by the Commissioner if that stock has diminished for any one of these reasons: damage, deterioration, change of fashion, decrease in the market value, or any other satisfactory item listed. However, please note that it excludes financial instruments. So even if a share dealer keeps their shares and the share value decreases below the cost price, we will not reduce the value of those shares in closing stock. And then closing stock we include in gross income. What do we mean by that? What do we mean that closing stock must be included in gross income? Well, if you look at the trading stock, we deduct opening inventory in terms of Section 22.2. We get a deduction for any purchases, or if we are manufacturing, the cost of manufacturing in terms of Section 11A, and then we add back closing inventory. So that is what we mean by add closing inventory to gross income. Now, Section 22.8 deals where we have taken goods from stock and we're using them for some purpose other than that which was intended, so selling them. And then we need to look at the recoupment in terms of Section 22.8. So we need to decide there are 2 options. Either we recoup at cost or we will recoup at market value. Now, there are only 2 instances where we will recoup at cost. All other instances we recoup at market value. So if we have private or domestic consumption, we will recoup at cost. Now, what does this mean? So this could be a restaurant owner that has a party and uses some expensive bottles of wine at the party. That would be private or domestic consumption, and that would be a recoupment at cost. Next we have if we donate or dispose of the trading stock for less than market value, or if the trading stock is given as a dividend in specie, we will recoup at market value. Now the next one seems similar in that if we donate to a public benefit organization and Section 18A is applicable. So in other words, we got a Section 18A receipt, so we can get a Section 18A deduction. Then we recoup at cost. So this is the only other time that we're looking at cost. Now, if we have donations to a public benefit organization and Section 18A is not applicable, so in other words, we did not get a Section 18A receipt, so therefore we would not be entitled to a Section 18A deduction, then we will recoup at market value. So make sure you read the information carefully to determine whether we are recouping at cost or recouping at market value for this trading stock that is donated. Then we have, if it is applied for a purpose other than the disposal in its ordinary course of trade, we will recoup at market value. So this would be an instance where we take trading stock and we use it in our business. So we take cleaning materials that we usually sell and we use them to clean our offices. We will recoup at market value. And then we'll obviously get the deduction under Section 11A for those expenditures used in the course of our trade by using those cleaning materials, for argument's sake. However, if we, let's say, are selling generators, and we take those generators and we take one of the trading stock generators and we use it in our business, here again, we will recoup at market value. So the market value of that generator we will be able to use to get a Section 11E deduction. However, if we were the manufacturer of the trading stock, so we manufactured the generators, and then we take those generators and we use it, or a generator, and use it in our business as a generator for when there are power interruptions, that capital asset will never be a capital asset. It will be dealt with in terms of paragraph JA of the gross income definition, meaning that it'll only come into account once we sell that generator. So this is only in the case where we were the manufacturers of the trading stock that we are now using for a purpose other than disposal in our ordinary course of trade. Those manufactured trading stock items that we use in our business will remain in our trading stock, so they will remain in essence as closing stock at the end of the year, opening stock at the beginning of the next year, closing stock at the end of the year, opening stock, until we actually sell those items of trading stock that we have now used in our business. Just remember, when we're looking at closing stock, we're looking at the lower of cost or market value. So that's what we would be keeping it in as closing stock at the end of each year. There are anti-avoidance principles in terms of Section 23F, which we'll have a look at. And remember Section 9C, which would deal with shares that were held for a revenue intention. So a share dealer, however, remember, if they are held for 3 years or more, they become capital in nature. So that's in terms of Section 9C5. And so then when we are disposing of them, we will in essence have a recoupment in terms of Section 9C5. Looking at Section 23F, the limitation on the deduction under Section 11A for trading stock that was purchased in the year. The deduction limitation, okay, only limits in the following circumstances, okay, where the trading stock is neither disposed of by the taxpayer nor held by the taxpayer at the end of the year. So what does that mean? That could be that there are certain goods in transit. So at the end of the year, those goods are not in your stock take, okay? So that would be not held by the taxpayer at the end of the year. Neither disposed of. So if those goods are in transit and we haven't issued the client with an invoice yet, then we haven't disposed of them yet. So we don't have anything in gross income, and we aren't holding the stock. So we don't have any closing inventory either. In that case, there will be a limitation on the Section 11A deduction that we would have gotten for originally purchasing that trading stock. The deduction is deemed to have been incurred in the first subsequent year in which the trading stock was disposed of. So once we actually issue the invoice, for argument's sake, the value of the stock is included in gross income. Trading stock was destroyed, or for some reason we cannot dispose of or hold the trading stock by the taxpayer. The deduction limit is limited to the extent that payment has been received for stock disposed of, and that's in terms of Section 23F1. Okay, so in the case where we have, let's say, goods in transit and we haven't issued an invoice for those goods yet at year end, we would have a case where we will limit the Section 11A deduction with regards to that stock that's in transit, because it wouldn't be fair to have the closing inventory, they have the deduction in our books, but not have the corresponding add back in closing inventory. So Section 23F in essence says, okay, well, considering you don't have it in your closing inventory, you're not adding it back to gross income, you cannot get the Section 11A deduction for having purchased that inventory in the first place. One more. Here it says you have purchased trading stock at a cost of $10,000 during the current year of assessment, and these items are still on hand at the end of the year. The market value of such trading stock at the end of the year amounts to $12,000. Required number 1, indicate the effect this would have on your taxable income for the current year of assessment. Ignore VAT. If you assume that the above mentioned items are not on hand at year end because they were donated to a local church, which is not a public benefit organization, indicate the effects, and then again indicate the effects that if the donation in point 2 was to an approved public benefit organization and a Section 18A receipt, what would the implications be? So in the first case, we're saying, okay, we purchased trading stock, so we're going to get a deduction in terms of Section 11A for purchasing the trading stock. However, the trading stock is still on hand at year end, therefore it's going to form part of my closing stock, and therefore I'm going to add it back at the lesser of cost or market value. Cost was 10, market value was 12, so I'm going to add it back at 10. In point 2, we are now saying, okay, this trading stock we purchased, so we're still going to get our Section 11A deduction. It won't be in closing stock. Our closing stock will be 0 because obviously we've now donated it. However, we will have a recoupment on this trading stock now used for another purpose, and it will be recouped at market value because we did not donate it to a public benefit organization, and therefore Section 18A will not apply to this donation, so we recoup it at market value. If we take the instance number 3 into account, where we said it is a public benefit organization, we did get a Section 18A receipt, then we can get a Section 18A deduction, or we would be allowed to get a Section 18A deduction, and therefore we are going to recoup it at cost and not market value. So that's an important differentiator where we donate trading stock. Whether it is a public benefit organization, you also need to go that step further and check, did they get a Section 18A receipt, which would entitle them to a Section 18A deduction. If you can get the deduction in terms of Section 18A, or if you qualify for the deduction, it doesn't necessarily mean that they do get a deduction. It just means that they would be able to qualify to get the deduction. You would recoup at cost. If you cannot qualify to get the 18A deduction, you will recoup at market value.